So how do you leverage your life insurance policy? Of course, it's got to be a cash value policy to invest in real estate. Well, there's lots of ways. I have clients that are real estate investors and they're like, hey, how do I make my money work for me and use the money at the same time? Well, this goes for anybody, whether you're using it for debt reduction to save on high interest rates, for example, or just paying interest to a bank, or you're using it for real estate. And now, mind you, real estate is a cash flowing asset, so you're bringing money in, but you can use your life insurance policy, basically you're using it as collateral so that money stays in there and continues to grow with compound interest uninterrupted. So even though you're utilizing that money, even though they'll show a decrease in cash value of your policy, the money's still there at the full amount. So it'll continue to grow while you use it. Yes, you're paying an interest rate, say roughly 4 or 5% or 4 to 5% to the insurance company, but you don't have to go through a loan process, credit check, all of that stuff. All you have to do is fill out a form real quick or go online and do a couple of clicks and you can get a loan and it can be in your bank account within 2 to 3 days. And if it takes some of them take a little longer depending on the company, but nonetheless, if you're putting your money into these policies and then you're able to borrow against it, and then that money you borrow against, yes, there's an interest rate. Well, then you're able to, one scenario is you have a separate company that you utilize as a private finance company. That private finance company loans on all your deals, right? So say you're you're rehabbing houses, you're flipping houses. It'll loan, so you charge from you personally, you're getting, say, charge that 4 to 5%. You could charge another interest rate to you loaning it personally to that company, that private finance company. And then from there, they'll charge a different interest rate to your whatever company you're using to do those deals out of. And I know that sounds complicated, but I mean, once it's in place, it's not a big deal. But say you skip all of that. Say you just do it, you're paying the interest back. Well, of course, check with your tax attorney or your CPA to go in and verify this. But typically what will happen is you're able to write off the interest on the loan. You utilize the money for whatever deal you're doing, and then the money gets paid back. So for example, with the flip, they rehab the property. Maybe they have enough to cover the home purchase and the rehab. And then when they're done, they sell the home. They not only get all their cost back, and then they have their profit. So they're paying this back with interest over here, and it restores the cash value to the policy. And then you're able to write off the interest, right? I mean, this money continued to grow over here at its percentage rate. It depends on the company. So let's just say it's 5 or 6%, and that's before cost of insurance. So maybe the net is 4%. Let's just say it's 3.5%, 4%. It's going to keep growing each and every year, no matter what. And you're putting more money into it every year, paying premium, and that money will yield dividends and interest every single year. And then there's a guaranteed rate, so there's a very minimum. So if there was a horrible year for some reason, but the majority of these companies have paid dividends for the last almost 200 years, 100 or well over 150 for most of them. So you're able to make whatever percentages. Let's just say you make 15%. It could be more. I'm just giving a number. But say you make 15% on your flip. of your cash on cash return. It's probably going to be more than that, but let's just say it's 15%. You paid 5, and then you are gaining over here inside of the policy at the same time. So you're gaining here and gaining here. So yeah, you might have borrowed some money in between. It's no different than borrowing equity out of, say, your personal home, going and putting that for a down payment, or maybe paying for another rental home and then making that rental home cash flow. You have a loan over here that's causing you to have an interest rate of some sort. You're paying interest. But you have this house over here that should be cash flowing if you bought it right. So it's the same idea. One's just using houses by itself and using the real estate as the collateral, or this other one, you're using your insurance collateral. And then, of course, the insurance has other benefits, but you're able to leverage your life insurance. The life insurance obviously has a death benefit, which is always going to be 99% of the time is always going to be more than what your cash value is. Well, I shouldn't say that. It's probably higher than that. When I say 999. There are situations where it would equal, but most of us aren't going to live that long for it to mature. Maturing meaning that you hit 100 or 120 or whatever the case may be, how they've run the product. So most of us are not going to live that long, so you would never see the two match. Whenever it matures, they'll go ahead and say, okay, well, you've outlived all of our expectancies, so here's the money. They'll just give you the death benefit because it's all cash value and it's matured. So if it's to age 100, you get your money back. Most people never see that. But nonetheless, I'm getting off track here. But many of them have living benefits. So for chronic illnesses, critical illness, stuff like that, you're able to do it. In some cases, maybe they have what's called a long-term care rider. So it can be used for long-term care that would have certain benefits of having that rider on there. In other cases, I'm trying to think of all the benefits of things that can be covered or that are a part of a policy. Those are the main ones. There again, it depends on the company. It depends on even the product. Some products have certain things or options, I should say, and others don't. And they could be within the same company. They just, one's maybe a shorter pay period, or other ones you pay till you're a certain age, to age 100. They all have the same basic benefits. There might be a few things that might be slightly different on some, but nonetheless, you're leveraging the real estate, or you're leveraging your life insurance policy to increase your wealth. And anyone who's looking to get into it, maybe you've been paying on a permanent policy for many years. You should check what you have in cash value. You might be able to utilize that for investing. And if you don't, if you have a lump sum of cash or whatever, it's what I normally do for my clients is they might have a lump sum. They might have 100 or 200 or whatever it is, $1,000, and they'll start off by putting that as premium into the policy. We'll structure that policy as such so they'll have the majority of their money available. And in the first year, it depends on their needs really, but it'll be anywhere from 60% up to, it can be up to 90%. Well, no, not anymore, but not after the change that they made with the tax code, but it'll be about 85, 88% in some cases. It just depends on the policy. There can be some that are higher, but there's things that come along with that the type of policy and stuff like that. But it's a great way of saving money. So you have the savings over here that's going to continue to grow. So you can save money and spend it at the same time. Where else can you do that? The only product I know of you can do that with is life insurance. Please like, subscribe, and click the notification bell. Again, I say this on every video, so it's probably a little redundant by now. But any questions, any content you'd like to see, put it down in the comments. Have a great day.